Total labor force now at a record high. Our Steve Liesman joins us with more beneath the headlines. Steve.
Yeah, Sarah, it was an inline jobs report that had a few hints of weakness in it that I just think bear watching here. Let's go through it. Non-farm payroll was up 164. 165 was the estimate, so you can't get better than that. But those May-June revisions down 41,000 is what the concern is right there. Average hourly wages, pretty good, up 0.3%. Unemployment rate unchanged, and labor force participation ticking up to 63%. So that's good. But along with the downward revisions, there was weakness in manufacturing hours worked. Manufacturing hours have been negative or flat for 11 of the past 12 months. You can see that right there. They registered their biggest decline this month since 2015. And everybody knows this is the industry most sensitive to both trade tensions and global economic weakness, so we want to watch that. Let's look at some of the other details. Education, health services, 66,000. It looks like local education workers came back a month early, so you had a big pop in July there. That was probably responsible for that. Information doing good. Manufacturing this month doing well, but the yearly average has declined from 8,000 to 8,000 from 22,000 the prior year. Government getting a pop. That's where that education shows up. And temp help, that doesn't tell me that there's a whole lot of extra hiring going on there. That number should be strong. It's a good leading indicator. On the plus side, the participation rate, it's been up the past 2 months as more Americans have come into the labor force, as Sarah said. The Fed likely sees some confirmation in the support from its decision to ease on Wednesday, and not ease a whole lot, but just ease a little bit. But the effect of the jobs report, overwhelmed by the threat of more tariffs on China, that effect is to dial back in the chance of that third rate cut this year by December, Sarah.
So where do you stand, Steve, on how the economic outlook has changed, if at all, this week? The new 10% tariffs on U.S. consumer goods, and whether the Fed is going to be actually able to do anything to fight that and alleviate the pain with another rate cut?
I think the sequential answer to that, Sarah, is yes and no. I think it's hard to see anything but somewhat weaker economic growth as a result of tariffs. Every single estimate I've seen shows that it takes something off of GDP growth in the tenths, from 1/10 to 2/10 all the way up to 5/10 if you put it all together, so maybe half a point of growth. And I think that it does not offset trade. It's a little hard for me to see. I think the chairman has a point when he talks about the confidence channel. Hey, somebody's doing something about this, but ultimately decreasing the cost of capital, I don't think offsets these taxes that we're putting on the American economy.
Hey, Steve, finally, really quick, I was struck by your point on Squawk Box this morning about whether employment is next in line after CapEx from worried, cautious managers. Can you expand on that?
Well, I mean, I was taking off what a guest had supposed. He goes, look, at some point you bring CapEx down to as low as it can go. And what is left on the next thing? Well, you bring SG&A down, obviously. But in terms of how CEOs express their confidence, they express it by building new plant and equipment and hiring new folks. Well, we've seen this decline in the growth rate of capital spending, and we'll see if that gets down to a place where, hey, I can't cut here anymore, so now I'm going to reduce my hiring. That would be an effect, and we'll see how much this whole tariff thing plays out in terms of confidence, or whether or not we get some kind of bounce back from the lows we've been.